Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon. I see Gavin's popping in. Love to see that. G-Man back in the building. How's it going, Gav?
It's good, Robert. How are you, man? It's
Yeah.
good to talk to you. I haven't been on here in a little bit.
I know. I missed you. We've missed you. You're how did the Suns basketball go?
It was good. It was my first time coaching, and
Oh, cool.
yeah, it was cool. He's in fourth grade, so I didn't even have basketball in third and fourth grade. I started like fifth and sixth grade,
Cool.
and I played. But he had fun, and it was a good experience. So
That's wonderful.
yeah, but
That's
pretty demanding. More than I thought. It was like 3 or 4 nights a week sometimes.
Did you know that when you were going in as a coach?
No, I was
Okay.
I was banking on like 1 or 2 nights, and it's like
Right.
sometimes like 3 or 4. So for a fourth grader, that's a lot. Yeah.
It is, yeah, for sure. That's funny, but yes, I feel like a lot of sports are a bit different than when we were growing up, Gavin. A lot more intense, a lot more practice.
I saw you and the boy out snowboarding, carving it up.
We
right?
were,
Yeah, that's cool.
Yeah, we got like 5 inches on Saturday. And so I just, asked him kind of midday on Saturday. I was like, "Hey, do you want to go snowboarding tomorrow?" He was like, "Oh, that'd be awesome." So we've gone a couple times. He's getting the hang of it. He's pretty close to. I think by the end I convinced him he's ready for the chairlift. So I think we're going to try that out maybe this weekend. I think we're supposed to get some more snow later this week, which is great. It's always good to get snow in March because it's still cold, but it's not quite that like bone chilling it's not quite the yield curve bone chilling cold in terms of like minus or like 20 to teens.
What we saw
Fahrenheit.
yesterday, yeah, right.
Yeah, exactly. So it's good. No, I'm so proud of him. He's turning 6 on the 25th, so in a couple weeks, and he's doing a really good job, man. He's good.
He looked like he had a good handle on it for a 6-year-old. I mean, yeah, pretty impressed.
Yeah.
So cool. Well, thanks for doing this, man. Yeah.
Always. Yeah. So just we'll kind of get going. We got 2 great Jedis here joining me today with Gavin and Mitchell. But I have had quite a busy day. But this is the Weekly Notebook Review. I don't know what episode it is, Gavin. We've been doing this thing since November of 2021. So it's well over a year, and it's been a lot of fun. So for those that are listening in that might be new, I was I now wear the Hedgeye jersey, but I was a subscriber before that, and really just still very passionate about the game, helping others, helping the community, and this is one of the best parts of my job is certainly hosting this Spaces session. I'm honored to have 2 folks that have become very dear friends, both Gavin and Mitchell, and many others out there. I see Walter, Pokey, Wasim. I mean, the list goes on and on. We got, Michael Loftus is out in the building. Anyways, there's a lot of great friendly faces that I've gotten to know over the course of the last 3 years of being a subscriber. So just wanted to reiterate how humbled and honored I am to be the one that kind of gets to spearhead this conversation and guide through the process, because it's a little bit different for everybody in terms of how they execute and take the Hedgeye research and put it into their own practice. But it sure is a heck of a great tool and one that you can really leverage to a very positive manner, I guess is the way I'll say that. So with that, today we've certainly back in a quad 4 bear market environment. A little bit of green on the screen today, but we won't. I mean, I don't know if calling 14 positive or 14 basis points of positive gain on the SPX is something that I'm going to really chalk up to the bulls. I'll call that a neutral, a kind of a draw. But we certainly, a little bit of a bounce last week in terms of what we were talking about last Wednesday on here, and yeah, Keith and the team and us, we all kind of, I think everybody listening in likely kind of took the other side of that going into the Powell speech yesterday, and I think it's more than just the Powell speech. I mean, he really, there's a funny cartoon that we put out yesterday, which is really just that he reiterated what he's been talking about for the last 12 months. I mean, nothing really has changed in terms of the overall outlook and the nowcast model, and certainly what Powell has been talking about and Lagarde over in Europe, et cetera, et cetera. That 2% inflation number is still one of their key targets, and they're going to try to do everything they can to get there by tightening the screws and doing so into a recession. So recession risk is rising. That's what I tweeted out to everybody this morning, and I think that's really that's been a key theme that I've been presenting here on Weekly Notebook Review the last month plus, is really kind of keeping your eye on that recession risk that's on the horizon versus the inflation risk. That's really something that the risk side of inflation has been something we've been focused on for the last 12 months, and certainly inflation to the upside was something that we had put in the portfolios back in starting in 2020. So that's kind of where we're at right now from a global picture. I think that keeping a keen eye on that recession risk rising is certainly something that will prove valuable as we probably exit 2023. I think that'll be a good pivot if you are doing that in your portfolios currently, or certainly have that on the docket to do so, or sort of managing around it right now. It doesn't mean that we're not going to get sort of some rallies and that kind of thing. Trying to pivot a little bit of what may look like quad one data right now on that nowcast model. It's it's a bit of a toss up just on a technical standpoint in regards to the quad which quad one might fall into right now. But obviously we're going to get more Feb data here in the next few weeks. And then the last month of the quarter as well will obviously influence where that ends up landing at the end of the day, and actually on paper officially. So it's not like worry less about the quad, but we've said this a number of times both on here and a beginner's guide is the signal trumps the quad, right? So that signal right now continues to reiterate that you want to be bearishly positioned, and sorry, not bearishly positioned, such a broad word, that the quad 4 regime is the one really that has the most the best opportunity, or the kind of the portfolio construction that you really want to be focusing in on and harnessing in on. So there's some key things that I want to talk on today, guys. I'll pass it over to either of you really to kind of go through what you're seeing out there. But I think reviewing what's happening on the long end of the curve, certainly that 30-year and 10-year, and again the signal, it's what it's doing, and then on the dollar, the FX strength, I think would be and commodities. So kind of those three big asset classes would be ones that I'd like to make sure that we touch on in the next kind of half hour or so.
Yeah, no, Mitchell, unless you have anything, I was just going to say I thought it was pretty interesting yesterday when Powell was, giving his testimony, and the politicians were kind of beating him up here and there, and the front end of the curve, I think I saw maybe the 3-month was up 14, 15 basis points, up over 5% for a 3-month T-bill.
It was acting like Tesla.
Yeah, but that was the market watching Powell saying, I didn't hear everything he said. I had it on in the background. But that was basically the market saying, he might have to hike more than he said, and then you have to remember, we do have the FOMC dot plot, slang for their summary of economic projections on March 22nd. Mm-hmm. So it's a little bit bigger of a meeting. And I mean, if you go back and you look, it is kind of interesting to look at where the dot plot meetings, fall, where they fell in 2022. And when the minutes get released for those meetings, that's usually when there's a month off where there is no FOMC, and kind of that window, that 2 or 3 week window, is not like a time for me to make a call, but it certainly is a time to kind of watch where things are. And if you get signals in and out of that, period of in time and space, I think it's really important to kind of take note of what happens out of that. And I mean, for me, the beginning of this year has just been, kind of like low clarity in terms of, like you just said, Robert, like the signal short term saying one thing, and then the economic data saying another. And, I guess what's made it more palatable is that there is, that T-bill yield, which everyone knows about at this point, but it makes it a little bit more palatable to sit and be patient, and so I'm expecting over the next 3 or 4 weeks to get some more clarity.
Yeah, just on the market expectations in regards to the rate hikes, I thought that it was I write the number down every day, but yesterday's being, plus 1.15 more hikes versus this morning's data, post to your point, Gavin, like post Powell's commentary and the market really realizing, hey, he's for real here. That number went up to plus 1.71 this morning. So it was a big, it was a big move. Again, I mean, that's basically what, like 60-ish, 69% or 69 point kind of move in terms of like more rate hikes expected. And they're kind of baking back in that 50 bips hike versus what had been sort of maybe flat to 25 basis points. So definitely a huge, great takeaway there. I actually haven't listened to Powell. I full disclosure, I've not listened to Powell's speech or conversation on neither yesterday nor today. That's how important it is to me. It's not that important. It's more important in terms of like what is the market reaction, and then what are the signals doing accordingly, right? That's just how I operate, man.
Well, that's the beauty of it, right? You don't I mean, we had it on at the office. I was out in Ohio yesterday.
Yeah.
But if you didn't, and then you just happened to look on TradingView and see that the 3-month was up 14 basis points, well, then the market was like, well, that was hawkish. I mean, it's like exactly. The market tells you really all you need to know. So.
Yeah, exactly right.
I didn't see the cartoon that was put out, but it couldn't be more spot on. I mean, it's not like this hasn't been something.
Yeah, I'll see if I can find it and put it in the nest.
Yeah, it's not something. This isn't something all of us who follow the data hasn't been saying. Powell's literally been reiterating at each and every step along the way. 2% is their mandate. No, it's not 3. No, it's not 4. And every one of us has been saying it doesn't matter if it's 6, 5, or 4%, mid 4s. That's still 100+% away from their 2% mandate. And he continues to reiterate at every meeting. What we've learned from the 70s is that stopping too soon, there's more of a risk of stopping too soon and having inflation roar back than not, right? So when you put all those things together, you just sit there and scratch your head and you're like, okay, so he's hawkish. It's what we've been screaming for the last 9 months. Everybody says that the market's discount in advance, and then you see these knee-jerk moves, and you're like, well, why wasn't the market like what does the market need to? They need to be spoon-fed, or I just don't get it. Sometimes it makes me kind of scratch my head, but anyway.
And my apologies. Yep. It was a tweet from the Hedgeye account, so I put up in the nest. But it was still funny. It was like breaking. Man talks about something he's been talking about for 12 months.
Yeah.
It's a picture of Jay Powell.
It's so true. It's so true. It's so true.
I saw it this morning. It just made me chuckle. Yes.
I think.
Yeah. So Mitchell, I mean, go ahead, Kevin. Yeah.
Well, no, I was just going to say to kind of echo that too with the dot plot. Like what you get when you like look in under the hood there is just like some simple stuff like, the Fed, has projections, and I'm not going to comment on the quality of the projections. They're not always the best, but certainly Hedgeye has better projections, I would say. But the point is that you can see that they think that unemployment will rise over the next year, and it's like that's what they're projecting, and so we'll get an update on that on March 22nd. But the point is like if unemployment starts to rise, they're just going to be like, okay, well, that's what we thought was going to happen anyway. So it's important, I think, to just know what they think is probably going to happen, and then keep checking in on the data to that you guys put out every day to say like, well, what are they thinking when they see that come out? So but yeah, I mean, the takeaway is just it's going to be higher for longer, and for average people, that just means like at least we have a yield on a T-bill right now. I mean, really.
Yeah.
So
It's I'm going to tie right into what you said in a second, Gavin. I apologize. I don't know if you just saw it, but Silvergate Bank Silvergate Capital is winding down their operations and liquidating Silvergate Bank, just announced. So it's not like we haven't been talking about that one too.
If Mike T was on here, what would he say? He'd be blotto. Blotto.
X2 just tweeted blotto and tagged Mike Taylor. so
yeah, great. Yeah, it's good. Mark Cohodes had that on with Keith back in November. That was great video.
So to Gavin's point, there is yield to be had at the short end, along the curve. This is going to sound probably conspiratorial and funny, but everybody's kind of ruled out. Like everybody's kind of automatically thinking that our government is going to work something out with the debt ceiling like overnight. And I just don't have that much faith right now in our government. So Steiner keeps talking about CDS bumping up on U.S. Treasuries, and while I don't think we'll in quotes default in the long term, at the same time, things could get sticky and messy, at least leading up to June. So I'm not pushing all in on Treasuries just yet, but definitely a spot to have some to pick up some yield. To talk about what the three things that you wanted to hit on, Robert, USD, 3 weeks we've been talking about it building strength, right? At least building strength when it was down at 102, 101, 102. And we said that this was building signal, right? It was looking strong. Commodities with the neutral on copper, that's big in my opinion, just simply because if you look at the commodity complex, even with the narrative, right, the China reopening narrative, if copper loses strength, you've got your quad 4 plays, right? The 30-year top end of the 30-year risk range coming down from 405 a couple days ago, right? 405 on Monday. I think that's very telling and big. I'm still, the 10 years still making higher highs is showing you the 10-year might still have some legs, but probably close. The one thing that continues to stick out to me, and I just keep thinking beach ball underwater, is the vol complex. I mean, to me, it's the last straw. It's whoever's doing the manipulating, and I am positive somebody is doing the manipulating. At some point in time, markets were relatively flat today, right? They were down most of the day. You can't even call what the closes were like up. And
yeah, like 14 bips.
I mean,
does that really count?
Right. And
S&P was up $5.64.
Right. And you had VVIX down 4.5%, Vixen down almost 2%, and RVX down 2.3%. I mean, come on, really? It's just so yeah. I mean, I know we talk about the ODT options, we talk about a lot of stuff, but you have bombs like Silvergate blowing up, SBNY is probably not far off. You see these bombs in The car company last week that just couldn't get their 222 million ABS. They shut their doors overnight. The number of stories, and I think one of the biggest stories that not many people are talking about is the PIMCO story being handed back 7 buildings, $1.7 billion default, if you will, from Colombia, right? These buildings, these multi-billion-dollar buildings are just being handed back. Like, what are these companies going to do with empty buildings and nobody to fill them? It's easier to lie when it comes to the private side, and that's where a lot of this is buried. Private equity, pension funds, where there's very limited exposure. So it's much easier to lie or fudge the truth in that world, but eventually it works its way through. And the quad 4 playbook, if you will, is showing up in the data. January was squirrely, but also, like we talked about in our note, when mortgage rates started to tick down, that's when the housing data started to incrementally improve. But then you have Powell and interest rates back up to highs, and then you had 2.5 to 3 weeks of a crush in mortgage applications and stuff until today, which was a little bit of a bounce, but still below the 180 that it was at for the past 2.5 months. So the data is normalizing based upon what the quad 4 data is saying in the higher for longer thesis. So as much as people would like to say the bear market's over and it's a new bull because we had a great January, I would be very, very hesitant to jump onto that narrative with all that's going on. I'm not saying anybody in this group is. I'm just saying that's going to be a tough pill when this really all comes to a head in this higher cost of capital environment.
Yeah, exactly. In terms of the commercial building conversation and the comment you made about PIMCO being handed back buildings, Waylon and Keith talked about that last week, and that was a great. If anybody listening in hasn't had a chance to watch that video, I'd highly recommend it. You can find it on the Hedgeye website or the Hedgeye YouTube channel under the Real Conversations handle. That was he specifically mentioned that commercial real estate, specifically, I think he said like San Francisco and New York, which I believe Columbia is handing them back in.
San Fran.
Isn't it both, or is it just San Fran?
Columbia,
right?
San Fran, but there's a building in New York.
There's another building one in New York.
Well, there are
anyway.
There are multiple in New York. There are multiple in New York, and as Danielle DiMartino Booth recently mentioned, the odds of the 277 Park is probably going to go at any point in time, especially with a $1.375 billion fine looming if they don't become green compliant, if you will. So, I mean, this is just getting ugly, and that's what BREIT would like you to think. Their portfolio is still up X percent as they have $5 billion in redemptions, but we settled a third of them as more line up, right? I mean, it's just, it's just they're full of shit. This is, I mean, this dynamic of higher rates is it's something that we talked about. Other side, whatever, we talked about from 2018 on, and there is something that Waylon, I mean, I agree with Waylon 100% on some of these things, and obviously writing about it in the third or fourth quarter of 2018, I didn't know Hedgeye or Waylon, so we were on to something. But when you move interest rates from 0% up to 1%, it's not just a 1% move. You're up 100% from where you were, and now you have rates at 5 and 6 and interest rates at 8 in many cases, right? I mean, it's at 7 and change. No, most people are paying 8+ with points. So your average car loan is 8.5 for prime borrowers. It's absolutely nuts. So, when you have these huge spikes in interest rate and everybody works off of a what can I afford on a monthly payment scenario, it from all the way down from the consumer up to the government borrower, you're looking at a really tough scenario. And back in 2018, we used Toys R Us as an example because they needed refinancing and they couldn't get it. And their bond was trading at 96 cents on the dollar until they couldn't get their financing, and then it was 22 cents in 36 hours. So, a lot of these, we've talked about it on and off, and we've talked about it generally, but a lot of these bond ETFs that just hold things because they have to, when these companies, the multi-trillion dollars globally that has to refinance this year, can't refinance, or they're refinancing at 200 to 300% higher than where they borrowed X years ago, you're going to see a lot of 96 cents to 22 cents overnight. And that's the credit event I think everybody's going to look for or wait for. Well, some of us are going to look for and wait for.
Yeah, I mean, I just pulled it up quickly. Like the U.S. Treasury 2-year, if you give it, I did it from 13 basis points, not quite zero, which is where it kind of traded a decent chunk, or around there. So it's like 13 basis points. It's up 3,700%.
Yeah,
up to where it closed today. So, yeah, it's not. It is 5%, and isn't that really? It's fascinating how a savings account, even just like a year ago or 18 months ago, a savings account at a bank yielding like 50 bips was like, oh, interesting. That's kind of better than anybody else around there. And now it's like, if I don't get 5%, it's like, what the fuck, bank? So well, a lot of them are still lagging though, right? Like none of this stuff's really been priced into any savings, like many savings account. They're still down at 2.5%, 2.5%. So it'll be really interesting to see how this all plays out. And the banks are really quick to lower those rates, but have been relatively slow, at least from what I've seen, in terms of raising them to the end consumer.
Yeah, you get yourself an account where you can just buy the T-bills, like that's what you got to do.
Yeah, agreed.
Yeah.
Agreed. All right, so Mitchell, you kind of touched base on this, but maybe we pivot over the commodity space. You talked about copper. I think that's a great call out. Obviously moved to neutral it's been bullish for quite a while. I didn't go back on my notebook. Gavin probably has this written down because he's a notebook connoisseur over there as well.
What are we looking for?
The copper. My notebook, I had to get a new one. So mine only goes back to the 24th of January, and it was bullish all the way back then.
It was bullish.
So it's
bullish as of January 3rd, and that's as far back as mine goes. So it's January 2nd. So
all right. So it's been, call it 2.5 months.
It's been a bit. Yep.
Yeah, it's been a bit.
It's correlated with gold, so I would expect. Well, no, that depends. It depends on Keith's signal, I guess. But yeah, it's been. Well, the point is, it's been bullish for a little bit.
Right.
Yeah.
And it moved neutral, so that should have been something that was starred and circled in your notebook. I think that's a big move. Also has a bit of a read through to what happened in the Hang Seng, right, and Hong Kong, and China, right. China still remains bullish trend, but at the same time, just perhaps the robustness of kind of what's happening in their economy. They didn't announce any stimulus over the weekend, et cetera, or additional stimulus, I should say. So these things all kind of play or coincide with each other, correlate with each other as well. So, but definitely the copper move this morning in the risk range product in the signal strength, and then silver kind of remains. I think that moved to bearish, right? Yeah, that moved bearish from neutral day over day. So those two are really big ones that I called out. I mean, gold sliced right through the last trade level that I had from Keith, which was it's a little stale. I think it's from February 28th, so a couple weeks old. but it sliced right through, trade yesterday. And so again, just something to be conscious about and conscientious about as well. So wanted to kind of call that out here on the call. It's certainly below that trade level. I don't know if that's still the level per se, but again, just something to be aware of. I think that again, it's not neutral on the page, but typically when something's between kind of trade and trend, it certainly loses its signal strength, because the best signal strength is something that's bullish on both the trade and trend standpoint. So remains, bullish trend. It is above the trend level that I have, which is 1793. But so kind of keep an eye on that 1793 level, and because the rest of the commodity complex is pretty shite.
Yeah, I had noticed one thing that I did notice again is when Keith does nothing, it's doing something, and gold has not been added to. It's kind of moving its way down, not necessarily through sales, but through adding to other longs. So it's one that I haven't added to yet. If we do get this rollover in the 30-year and the 10-year starts to follow and it holds at trend, which is, as you mentioned, 1793, you said.
That's the level I had. Yeah.
Yeah, and I'm sure that's probably changes a little bit here and there, because last I heard it was 1803,
it's from like 2 weeks ago. So
right, but it's
So that was the level I had before. Just so you know, that was the level I had before. Was 1803. It moved down to 1793.
Okay.
He gave that out on the macro show. I think it was on the 28th. So he gave the trade and trend level on the 28th.
Yep, got it. Just something to note on gold.
Absolutely, and again, to get gold technically isn't a commodity.
Yep.
Right. So acts differently in this in kind of commodity complex, more driven off of demand, supply demand situation, complex, and so this is where recession risk rising forces demand down, which forces the overall price down. Right. So this is kind of what we're seeing. Oil is interesting, I will say. It's sort of been, we talked about this last week, kind of range bound between, call it 83 and kind of 73. So it's for the last like 3 months, really. So it's definitely an interesting dynamic there. OVX is down at like 34. But again, Mitchell, you mentioned this in terms of like volatility complexes in general, keeping kind of a little bit of a grain of salt on these things. They're not quite acting like I've seen them historically in the past, and so they're, I don't know if it's true vol suppression or it's just the mechanics just aren't, at least like that, to the products that are readily available to most of most investors in regards to VIX, RVX, GBZ for gold, OVX for oil. These components just, they're not kind of really acting as I've seen them operate in the past with but then again, I mean, when you've got an oil range bound between kind of 73 and 83, that volatility is pretty nominal on the last 3-month basis. So again, it does, I guess, kind of make sense as well. So if things play out from a demand standpoint the way that the nowcast model is kind of predicting, then we would think to see that oil demand will continue to weaken, and therefore price would do so as well, and that really plays right into a quad 4 playbook. But yet, Mitchell, great call out on real rates and the influence of basically the longer end of the curve, positive kind of correlation, or I guess inverse correlation, positive inverse correlation with gold. So as the signal, or the kind of the 30-year and the 10-year start to kind of put in lower highs, that could positively influence the price of gold. But we'll have to kind of see it. I'm personally looking for it to kind of hold this trend level, right, or at least kind of hold a level here. Whenever you see a big candle down, a big move down like we saw yesterday on volume, that that kind of just gives me. I personally just let things kind of breathe a little bit.
Yeah.
Yeah, I agree with you guys. For the way it played out, for me, over the last couple of days, I took my first shots on gold this year. Actually, been wanting to, and I don't have a lot of, I guess, conviction or in it. Like I may have to just kind of pull the plug on it. Like I see where it's correlating. It is trading like a commodity. And the interesting thing about gold is that it can go in and out of, it's got that extreme correlation against the dollar still. And so the dollar, over the last 4 or 5 weeks has come back over the top and been a headwind to stocks and the whole thing. So it's like I would like to see. I mean, it'd be great to see the dollar and gold going up together in like a quad four, but right now that it's going to take a lot of work to get that, moving. So I don't know. For me, it's like very, like I said, kind of low clarity into the FOMC. And one thing that I realized so far about this business is that a lot of people have trouble saying they don't know. Like they always have to know and have a really strong view. And for me, it's like I've seen, if I go back through my notebooks, like I could easily see quarter over quarter where, clarity comes in and out. We've talked about this, I think, many times before, but so sometimes people are like, well, it's a cop out to say you don't know and it's low clarity. It's like, well, for me, it's been pretty low clarity for a while. Like the last time I really got aggressive was back, summer, early fall of 2022, and that's okay for me. It's like, and then I'll sit and kind of wait and see. And so yeah, it's gold has been interesting, but I'm right with you guys. Like I could see it. I understand why maybe Keith didn't add to it. For me, that's the spot that I came in. But I don't trust it, because I see what's going on with the dollar. So we'll see.
Yeah, I agree with you, Gavin. I think the dollar was a much more clear setup as it started to build strength and signal when it was down at 101, 102. I think gold is much less clear, right? I don't know, and I'm in your camp. I will know more. I think we will know more with a little bit of time and space if it holds trend and it continues to bounce off of trend, making higher lows, etc. So today it went from 1810 to 1812 in terms of where the low was. It probably will be down a little bit today. The low will probably be down a little bit today. So it's hanging in at trend, but I have, we always kind of joke about the word conviction, right? It's not less conviction. It does not have nearly as much strength as the dollar was showing when it was putting in its low, but we'll see over the next couple weeks if it starts to, hold in here and you start to see the 30-year, continue to put in lower highs. Well, then you have that trio, which could start to trade well together. That's something that I will be looking at very closely as we go. But I'm not super convicted on any of it. The dollar is, I'm much more firm on the dollar as we saw it kind of transpire. And I do have short exposure to the euro and a little bit to US yen, right? But outside of that, I'll wait to be aggressive on the other side. I have a little bit on each position. I have a little Z-RAS on and a little TLT on, but still, as I mentioned last week, I think it was a 2.5% position. I think it's still, between all three of them. And I do have some gold on, but it's not a boatload, right? So it's kind of just a placeholder right now.
Yeah, conviction's a tough word. There's a lot of tough words, but I mean, there is for me, there is like gold is a position that this year, like it was flagged for me as like, okay, this could work this year. Like gold could have a year like where it's like a 10 or 15% year, like the dollar was last year. Like, okay, I could see that potentially with the backdrop and everything, but then you have the signal. But so for me, like gold came out of October, November, And that was kind of like a preseason run. If we think about it like football, like
Yeah.
there can be players that have great preseasons. Some of them could go on to have a great, awesome season. And then some of them can fall flat on their face and be like, man, that was just like a good preseason. And now he's not looking so good. So that's kind of where gold is for me. Is kind of like, okay, if this is going to be a big market, like, because when people talk about gold, they're like thinking, gold bulls are thinking like, well, it's going to be up 20%. It's like, all right, well, for it to do that, like a lot of things need to change here, and it needs to start. And then if it becomes that type of trend, like the dollar was last year, then for me, there's spots where I could use the word conviction, because like how big I got in a dollar back in August in that real like traditional bullish consolidation within a bullish trend, that's a different trade. That is one where you can say, I do have conviction and I'm going to push in this much on this because it's actually proven itself. Where gold has just kind of had like a good preseason and there's potential there, but I just don't, it's not there for me yet to really say like, so I guess it boils down to like, I could pull the plug on this really quick,
Yeah.
and we'll just see.
I agree. And one thing that none of us have spoken about is a VIX spike into the 30s. Because if we do get a VIX spike into the 30s, and I understand that the risk ranges are not suggesting that right now, but if those spikes into the 30s manifest from somewhere, right? The very first spike into the 30s from when the VIX was moving all the way up from 11 and 12 and 15 and 18, right? That manifested from somewhere, and Hedgeye calls it quad 4, right? So if we do enter the F bucket, all bets are off, period, with gold and you name it. It most of that stuff usually does get smoked. So especially on the equity side, right? The gold miners, junior miners, etc. So I will be very, very cognizant of trend levels and where we are when the VIX does spike into the 30s. I would, just my personal opinion, I wouldn't be holding on to something if it's going the wrong way into a VIX spike into the 30s just because it's gold and gold is a currency, right? Just make sure you mind your ranges.
For sure. Well said.
Agreed. Agreed. Brian's popped up. I don't know if he had any popped up while we were talking about gold, so I don't know if he had any comments or questions about that, or if he wishes to give us his usual muni update. I'll take either one.
Yeah, can you hear me?
Yeah, buddy.
Good. It's been planes, trains, and automobiles this week, and getting ready on another round. My wife booked with a bunch of friends SEC basketball tournament tomorrow in Nashville. So be a lot of bottled water between now and Sunday, I'm sure.
That'll be fun.
But yeah, I've been grinding all day, and so I actually went through and did some notes here, and so my current setup is I am 45% cash, and that's earning a 4.24% in the Fidelity money market. I am 49% in individual municipal bonds, 427 tax exempt or tax equivalent yield of a 7.31. And then equity income strategies at just 6%. So really just kind of waiting for quad 4 to do its thing and create opportunities to redeploy that cash position. In terms of rates, so SIFMA, we've been tracking SIFMA. Reminder, that's reset every Wednesday, so it's a 7-day tax exempt rate. It's used for money market for markets, and it's used for tender option bond issuances for the floating rate piece of it. It moved down again to a 2.21%, which is a 59 basis point drop in 7 days. And then 4 weeks ago, it was at a 398. So we've had a 117 point drop in 4 weeks now. So it's really plummeted. And then a 2.21% at the 37% federal tax bracket is the equivalent of a 3.51%. So the reason that is important is because SOFR, which is your overnight rate, it's designed to replace LIBOR. It is at a 4.55. Should be higher because the Fed will move it up when they move rates. But that spread between SIFMA and SOFR now is only 49%, and it really should be up in the 2/3 or about 66%. So SIFMA's really come down and is in kind of a risk-off mode in terms of value. So may at these levels make a couple phone calls and ask what's kind of going on, what's kind of driving their ability to keep this low, this suppressed, because the taxable rate makes more sense now, just mathematically. In the municipal bond space, I went through the new issues this week on Fidelity to get kind of an idea of yields. And quite honestly, they're a little lower than I had expected. Last year, Q3, Q4, I started buying at 4.25 and got up to kind of 4.5. And then I was pretty full. And then there were a few odd lots that popped up on just a couple days at like 490s that I scooped up. Not real big lots, but kind of like odd lots. And there's a Holbrook, Massachusetts general obligation bond that's was posted here, and it's AA minus rated. And I noticed it was 4s at a 4.25 with a maturity of 2050 or a 27-year bond. And so a 4.25 at a 37% tax bracket, you would take 1 minus 0.37 to get a factor of 0.63. And so 4.25 divided by 0.63 is a taxable equivalent yield of a 6.75%. So, it's a meaningful rate, but I sort of expected with everything that's going on in rates for it to be a little bit higher than that. I thought we would start seeing more in the 450s. So there clearly seems to be some demand on the long-dated municipal bond space. But we're definitely retesting highs of Q3, Q4 of last year. And then from a fund perspective, MMIN that I like to track, it's really unchanged from last Friday to today. So pretty flat on the NAV front. I noticed my individual municipal bonds on Fidelity have rallied a little bit this week. So kind of in that flat to a little bit of a rally in terms of NAV. On the agency front, I noticed I posted before about federal farm credit bond. That's now gone. There's a federal home loan bank bond, 6.44%, maturity of 2035 or 12 years. Interest is semi-annual. It is callable after 6 months. So, it's a 12-year bond. They can prepay you beginning in 6 months. But it is an agency. So the thing about agencies is it's state income tax exempt. So an example would be New York State. So the highest tax bracket in New York State, when I looked at the chart in preparing this, is 10.9%. So to get that taxable equivalent yield factor, you would take 1 minus 0.109, which gives you the factor of 0.891. So 6.44% divided by 0.891 equals a taxable equivalent yield of 7.23%. So if you want to compare that to kind of an equal CD, that would be a way to do it. You would say, is my CD 7.23% or not? And if it's not, then the agency is a better purchase under that New York State example. That's your tax bracket. But really the lesson there is agencies are state income tax exempt. They're also local exempt if you have a high local tax. And then on the CD front, I posted this morning, Wells Fargo has gotten pretty aggressive here. I figure they'd be gone, but they're still up here as of close today. They have 2 5.25 CDs, so 5.25% for 18 and 24 months. They're both monthly interest pay, so you get a monthly paycheck instead of semi-annual or at maturity. And those are call protected, so they are non-redeemable for that 18 and 24 month period. And then I've gotten a few requests on corporates. I hate corporates. I don't buy corporates, but I went through the new issue corporates, and kind of the best bond I saw was Goldman Sachs, 5.875%, maturity of 2028 or 5 years, semi-annual pay. Note it's a triple B plus rating. So we're talking obviously lower than an FDIC insured CD, lower than a AA, high AA Federal Home Loan Bank agency, lower than a AA minus municipal bond, and it's callable after 12 months. So think about your options here. Like, that's a pretty poor option. 5.875%. They're only going to guarantee you it for 12 months. The credit rating's triple B plus, as opposed to something that's in the A category or higher, solid A category or higher. And they can pay you off in 12 months if they like, or they can let you take it to maturity for 5 years. And then just kind of to wrap this kind of all up into some best practices from my point of view and some conversations that I've been having with folks. Number one, as I reiterated before, it's okay to wait the quad 4 piece out on the equity portfolio. That's mainly what I'm doing. Again, the core account in my Fidelity is SPAXX. There are other options, but that's just the default. It's yielding a 4.23 today. And number two is to compute your taxable equivalent yield for your taxable accounts. And I went through those examples here a minute ago on tax exempt and agencies. But you need to look up what your federal and your state income tax is in order to do that. Number three is, to the extent you do invest in fixed income, have a plan for your interest payments. An example of that would be a drip into risk on assets, things that are bullish trend on a Hedgeye basis, or if you're going to have a specific payment of a specific bill or need, that's another usage of the income. And just as an example to give someone some math, so if you have an IRA, and IRAs usually have quite a bit of money in them, as you keep putting your 401k or your IRAs each year. So I just took the maximum. So that Wells Fargo CD, $250,000 max for the FDIC insurance, 5.25 produces $13,125 a year, but you get that monthly. So you would receive each month $1,093.75. You could then take that $1,093.75 and purchase, say, I'll just pick something, Meta, or a few different things. That's an example of a drip into risk on assets. So your principal is safe, you're earning a great rate, but you're also reinvesting that into something that's risk on and bullish trend. And then lastly, I've had a lot of folks reach out, and I had a really good call today. And I've never said this before, but I really think it's something that needs to be said. There are some people out there that I think need to consider having a partner with a registered investment advisor, specifically one that has access to the Hedgeye process and research, as opposed to an old wall firm. And in my conversation today, one of the things that I mentioned was, you may think you can do it all great today, but there'll be a day where you can't, and you might need some assistance, and you can start that partnership earlier rather than later. So I've never said that before. Never really came up in a discussion before for me, but it did come up today, and the person I was speaking to agreed that it was time for them to get a financial partner. So nothing wrong with that, and I think just is a best practice for certain situations. So, Robert, that's kind of all I've got.
Awesome, great rundown, Gavin. I know you've been on the T-bill front, but you got any kind of additional questions, or how are you fitting in some of these fixed income pieces into your portfolios, guys, from an RIA standpoint?
Yeah, just really, T-bills. That's about it.
Yeah.
And some guys do have municipal bonds. That's definitely not my area of expertise. That's when I call Brian or DM him like I need a call, right? Which he's been nice enough to have with me in the past. But thanks for the rundown, Brian. It is interesting to keep track of this. I remember, when we spoke, this was, I don't know, well back into 2022, but how is it in terms of, I think at that time you were talking about like deals being able to get done. Is that still kind of running smoothly on the municipal bond side?
Yeah, we've seen a little uptick in rates. So I had some deals, and I talked about it in December. I scheduled some about 100, little over 100 million to go in January over a 2-day period, and supply was real low, and we got great rates, great demand. Things had really compressed because just supply had dried up. And then all of a sudden we get into February, and even though February was one of the lightest months on record, I can't remember the statistic of how far back the bond buyer said it was, but it was a record-breaking light month. Rates still ticked up, and then here we are now, end of February into March, and the supply for March was pretty impressive, but deals are getting done, right? And I'm seeing rates that I'm a little bit surprised at, like that AA minus Geo Massachusetts deal, 4s at 4.25. That's what I was getting in Kentucky last year. And 25 years, because there's not a whole lot of 25-year deals that get approved by the state. I was seeing 450s. So I'm actually a little surprised, Gavin, that that deal's 4s at 4.25. I kind of think in the 27-year space, you would kind of want like more of a 450, just given the kind of the bond fall. But they're getting done, and again, the SIFMA thing, it's such a drop that I'm kind of wanting to know: is it a distress signal, right? Are people concerned and scared, and they're just driving money into these funds? I don't know the answer to that, but it just seems to me it really has shifted to an extraordinary low percentage of SOFR that hasn't even adjusted for what we know is going to be another increase.
That's interesting. And so you said those that 4.25 is kind of where you were back at the highs of call it like Q4 22.
Not the highs. That's where
okay.
it was my entry point. Was more at 4.25, and I think it gravitated up to like 450. When I bought 4.25 the first time, there was one issue, and I didn't see another that came in the 450 camp. But it went out 25 years. Most of the deals, are just 20-year deals that get approved by the state. The state oversees everything. So there's not a lot of 25-year paper, but when you do see 25-year paper, I was seeing a little bit higher than 4.25. And so for this to be a 2050 maturity, which is 27 years, to be a 4.25 just seems a little light to me. I mean, it's a AA minus, right? So if you're a fund and you have a mandate that says I can only hold AA paper, and this gets downgraded one notch to an A plus, have to force liquidation, right? So it's not even AA flat or AA plus. So to me, I just feel like it's a bond that I'm a little surprised at 4.25. But it just is what it is, right?
Yeah, and that indicates. Do I have that right? That indicates just demand for the bond.
Yeah, yeah. It seems to me to align. I think that's a to me we call it rich versus cheap, right? Cheap would be a higher yield. A rich would be a lower yield. So it's a little rich to me. If 4 is at 4.25, I kind of look at the bond and think it should be 4 is at 4.5. But that's just kind of me looking at it from a where I would buy it perspective. Does that help?
For sure. Yeah. Thanks, as always.
No problem.
All right, so I am catching a train tonight. It's the wife's birthday tomorrow, so heading back on a late night express train out of Stanford back to the Northeast, back to Boston. That train leaves in about an hour and a half. So I see Trent joined. I see our good friend from the UK, Chris Moyer, out there. We can open this up to just general conversations, but I've probably got another half hour or so before I need to wrap up and head down to the train station. But it's a lot better to do this here than it would have been for me on a train. That would have been not very nice for Hedgeye Nation. Much more focused energy and all that kind of stuff. But yeah, so why don't we? I don't know if Trent can speak, so normally he kind of jumps up and speaks if he can. So he can kind of just be in listen only mode. Moyer, if you can talk on the UK, great. Jump up. Anybody who wants to jump up and speak, why don't you do that? Trent just texted me saying he is on a train. So just a bunch of train boys here on the weekly notebook review. But that's all good, Trent. You just keep listening in, buddy. Should be out in 10 minutes. All right, cool. If we're still on here, Trent, by all means, jump up. We always love to hear the one, the only, the Trent Wizzo. But yeah, so listen, anybody listening in, you've got any questions, commentary, want us to expand on any particular pieces of inventory, signal strength, et cetera, we have covered a lot, obviously, tonight. We've gone through, if you're just catching up now, we touched base on treasuries, on the dollar, on commodities. We've run the gamut on a bit of volatility suppression, and most recently on the muni and just general kind of fixed income space by by our resident expert, Brian. So appreciate it.
Hey, Robert, I have one thing you could maybe talk about.
Yeah, let's do it.
Could you talk a little bit about, maybe just reintroduce everybody to that new, and I don't really know the full scope of it, but that new app and the green and red and what that is intended to be useful for?
Yeah. So good question, and happy to do so. So it's the Red Eye Green Eye app, or maybe Green Eye Red Eye. I don't know. Let me look real quick. I always forget what we called it. Yeah, Red Eye Green Eye. So I was right the first time. Red Eye Green Eye app. You can find that in the Apple Store or the Android Store, I think is what it's called. So I'm an Apple guy, but yeah, whatever. It doesn't matter. But yeah, so it's an app, and really, I kind of touched base on this last week a little bit, Brian, with Jimmy. And at the end of the day, it's just another tool in the toolbox, right? So kind of, it's a free app. It's one where Keith can communicate kind of larger signals, right? In terms of green meaning buy or bull, right? Bullish, not really bullish trend, but just sort of like what he's seeing in the market, right? So like if an intraday move, something's massively oversold, and for some reason he did it last week where he turned it on to buy, aka green, for a day, and it's been red since Friday, I believe it was. It might have even been Thursday. So it went to a snoozing bear this morning and remained a snoozing bear, aka just sort of a wait and watch environment all day today. So that's really kind of, again, I wouldn't really think too much about it or really kind of put too much weight on one free application, but it's certainly a great additional tool to have in the toolbox, along with all the other kind of products you might get from Hedgeye or other places. So I think that's about it, man.
Thank you.
Yeah, and it's an ever evolving process. App, like tool/application. It's been out for it'll be 2 weeks on Friday. So this is really its sort of second full week in iteration. So I'm also kind of learning as well, Brian, as I go about this and seeing how Keith is using the tool to communicate to folks. So I'm also in a bit of a similar boat. He's using it from the last kind of 7 days or so as a combination of kind of like immediate term, but also kind of capturing that immediate term move, right? So as I said, kind of switching it to sell in kind of overbought situations, or where he sees a continuation of downward kind of pressure happening, or currently, if we kind of use the current signal as a snoozing bear, as in, hey, we've been a seller. maybe we've been covering some of those positions and just sort of kind of a wait and watch situation. We're not necessarily pivoting to a buy, but because we need other things of immediate term confirmation, right?
Sounds good.
Yeah, cool, man.
I'm gonna put my notes. I guess I'll just attach them to your space so you can put them in the nest.
Yeah, cool, man. Yeah, if you just tag me, I can throw them up there. Or you.
Okay.
Yeah, that'd be great.
I'll just post them and tag you. Thank you.
Yeah, cool, buddy. Sounds good. All right, so Tony came up. Moyer, maybe I'll go with him, and then I'll come over to you, buddy. Tony, welcome.
Hey, Robert, how's it going?
Doing well. How are you?
Doing all right. Finishing up the day.
Good.
Yeah, so I wanted to, get up here and kind of just ask like a general question. I'll set it up a little bit. I've been a Hedgeye follower for about close to 2 years, I think now. I've been doing a subscriber since early 2021. So right at the start of the actually early 2022, sorry. At the start of really the bear market, back in November when we started to get into quad 4. So that was pretty good. But there are, I've done kind of success and failure really at the entire model. I've gone basically through a roller coaster on this thing, and there are just some things that I guess I still don't quite understand that are happening. For example, I think the first part of the bear market, I killed it, right? I was, going up. I was doing great. I was mostly doing options. So, I think the setup that I looked at to the guidance for Hedgeye was 2% top of the range for put, 1% if you're in the middle of the range, right? So I thought that was great. But for example, one of the things that I didn't quite understand that recently happened was that, this happened already. For example, Europe bounced 40%, right? When we had that rally from the dollar from July up to October, the short was great, right? I mean, killing it. But then, there was a 40% bounce in all European stocks. And, it kept hitting top end of the range for about 2 months. And then it finally got taken off trend, right? I got killed there. So, I figured how does one avoid that? I mean, I'm pretty good at hitting, the numbers. If it's top of the range, start adding and start building that short or long, whatever that is. But I do not understand how one could have avoided, for example, that particular instance where Europe was top end of the range for a couple of months and it just kept going. And yeah, it just kind of, I got run through. I didn't quite understand. I think I heard Coach say that he has not been in Europe since October. And I didn't quite get why the signal didn't came off until like late November, early December. Because, I have a job, right? I'm not in the market all day. I have about an hour and a half I can really get into and look at the trades, look at the signals. But yeah, sometimes I don't understand those moves. Sometimes even if it's top end of the range, you kind of start building and it doesn't quite work out, right?
You have to be careful. I think you said quite a few times there, and it just kept going up. So without oversimplifying it, when things keep going up, you don't short them. When you say you only have an hour a day, that's like, I completely get that. But in an hour a day, you can still have a look and see, look, this thing is up, whatever, plus 6% week over week and plus 10, 15, 20% month over month. So that's when you So for me, when those sorts of numbers are on the board, it doesn't matter what the risk range says, because we know that what feeds into whether it's trade, trends, tails, it's never going to be at the exact point for anything. Like just in
Right.
saying that, that's just for me. It doesn't matter what the risk range says. When things keep going up and up, and that's your words, that's the words you used.
Yeah.
I don't
Yeah, for
short it
sure.
anymore. It doesn't like. I don't care if it's the top end of the risk range. That's just me. If it's going up, I'm not shorting it.
Right.
There's plenty of
Right.
opportunities, like things like the people that do the technical stuff, right? It makes Robert says it all the time. You know, when things make lower highs, things like that, and you've heard Gavin say tonight about he's waiting for things to, you know, to confirm for him what they're doing, because lots of things are doing much about nothing. Obviously, Europe wasn't doing that, but that's where, personally, for me, it's about looking at less things, but watching what they're doing. That's the whole thing about Quad 4 for me, is that there's just so few things that you can look at. So you need to look at what things are actually doing and not just what's at the top end of the range, what's at the low end of the range, which is okay for trades. But like I say, if you keep getting those trades wrong by putting shorts on at the top end of the range, then that's a signal in itself.
Right. For sure. For sure.
Yeah, so
Um,
Tony,
And you also have to keep an eye on if Keith is coming out of it, right? It's losing signal. If Keith isn't shorting it at the top end of the range, just similarly to what I talked about gold earlier today, he's not buying more at the bottom end, at the low end of the range right now. So he's either and you can see in his positioning, if you're a macro pro sub, that his positioning has reduced, relatively speaking, to many of his other holdings. So he's moving that position down in his book, and if we'll see, right? We'll see what his signal says. Maybe he's waiting and watching to see if it actually holds trend, which we discussed earlier. If you were on, is at like 1793, 1795. So we'll see if it holds trend, and we'll see if he starts rebuilding his position, or if he cuts bait and fishes somewhere else. So he's not, in him not doing something there, he's doing something. Just because the risk range is saying, you know, it's at the top end of the range, it's the top end of the range. I mean, in Keith's long book, his, you know, short proxy of SQQQ is literally the smallest position on his book, right? Large in part because if you watch the RTAs, he said sell some yesterday, if I'm not mistaken. So you can't just go rogue. I mean, if you do go rogue, and trust me, I've gotten hit on my short semiconductor exposure last August. You
yeah.
know,
Yeah.
you just have to learn from those situations, right? So you can't just look at a signal and a top end or a bottom end of the range and say, okay, we're at the top end, I'm going to go big here, without understanding how that signal is looking. Like, is it just, as Chris said, it just keeps going up and keeps going up and keeps going up? You
Yeah.
know, that signal might be changing. So it's sorry, Chris, I interrupt you. I apologize.
yeah, Tony, this is a good question, dude. And I've touched base on a couple, not specifically Europe, I don't believe, in a beginner's guide, but we actually just released a bunch of all the questions, all the clips from the questions from the beginner's guide, which I host on Fridays at 11:30, out on the Hedgeye TV YouTube channel. So they're out there, a bunch of the clips. They're in 4 different buckets, and again, this might evolve over time, but basically they're in a portfolio management bucket, a macro big picture bucket, learning the process bucket, and then leveraging Hedgeye products bucket. So we've tried to curate them. There's about 60 plus different clips ranging from 2 minutes to 12 minutes. So again, I would go take a look at those. What you're talking about would kind of fall more on the portfolio management side. of things, right, in regards to kind of how you managing the portfolio. And again, I apologize. I'm not at home, so I don't have all my other notebooks on me. I'm traveling here at the office, so I only have the most current notebook on me. I guess this is a lesson learned. I should probably have the most recent one with me as well. But these notes go back to the 22nd, Tony, in terms of what I'm tracking, January 22nd. So this was after the big run. In terms of, let's just call it EWI, for example, for Italy, right? So in Europe in general, they bottomed in October and then really moved. EWI in particular, they moved from kind of 21 up to now call it 30 and a half, right? So 21 to 31. So they had a $10 move over the course of the last 4 months, or I guess 5 months. But on January 22nd, the FTSE on a year to date was plus 4.13%. 1 month plus 5.4, 3 months plus 11.9, 6 months plus 7. The CAC 40, so that's France, not Italy, plus 8.1% year to date, plus 8.5% 1 month, plus 14.9 on a 3 month basis. But on a 1 year, down negative 2.8, right? So again, still down from when this whole recession and quad 4 environment hit, but just on a 3 month trending, on a 3 month, this is just price, right? So the 3 month base is up almost 15%. DAX is up, plus 8.3% on 1 month, plus 17.7 on a 3 month, but still down 5.5 on a 1 year basis. So again, I track these across the board, week to date, year to date, 1 month, 3 months, 6 months, 1 year, 3 year, in terms of, and this is the weekend work, right? So, those are 3 components, the FTSE, the CAC 40, and the DAX, or 3 things that I track week in and week out in order to keep a keen eye on what's happening in Europe. Now, if I flip the page to ETF Pro, and the risk range is there from January 22nd, and I'd encourage you to go do this yourself, right? Go pull this up from the risk ranges on ETF Pro. We had Italy, EWI, in there, and in my notes there, on the 22nd, it was a 26.47 was the low end, up to 30.20 on the top end, and I've written down a higher low, but kind of flat week over week. So again, I would have been tracking that, and you would have been seeing, to Chris's point, higher lows and likely higher highs. Now again, I don't want to specify when those all happen, Tony, because I don't have that information here readily in front of me. But if I flip to the following week, it probably likely is on the 30th. I've written down next to Italy, big higher low and higher high. So right there, the next week, the trend range, and that's the longer duration, right? So ETF Pro is that trend range, the 3 month or more range. So it's incorporating a longer look back window. So when you're really seeing movement there, and specifically, on the short side, if you're seeing higher lows happening, that means the probability on a longer term look back window, it doesn't have as high of a probability of going lower, right? So like the risk return shrinks, and that's where, Chris, I guess I've never really said it in that term, and I'll probably think a bit more about this on the train tonight, and come and put a slightly more thoughtful beginner's guide comment together. But and again, that beginner's guide is less about beginners, is more about situational awareness, and then I think that's what we're going to rename it, is more situational awareness. But that doesn't matter. But my point is that low end of the risk range moved from 26.47 to 28.48. So that was almost a little over a $2 move on the low end of the risk range in terms of where the probable range on a trending longer term basis would have it on the downside. So when you're seeing that happening as the price, to echo kind of both Chris and Mitchell's commentary there, when you're seeing price move against you and it's kind of continuing to go against the top in the risk range, and that in the top end is moving higher, because you're not going to see that bottom end initially move up right away because of just all the pricing, the lower pricing that's inside of that window and the look back basis. But when you see that top end moving higher, and then all of a sudden you get confirmation where you get that first high or low, that's where you got to be like, oh, okay, maybe this is not as lucrative of a place to hunt, right? And I need to go look somewhere else.
Gotcha. Yeah,
So
for sure.
Tony, let me share with you somewhat similar experience, right? This is Trend here.
Hey, Trent.
And how I managed to get out at especially the options much earlier on. So first of all, I have a golden rule, which I tend to follow for my options satellite. And when I say satellite, I'm and satellite portfolio. Typically in core portfolio, I don't tend to short stuff. Those are mostly um, diversified set of holdings. They have a slight leverage in them, but not as much as options. Options total portion of the book dedicated is anywhere between 6 to 10% of the total portfolio. I'll repeat that again. 6 to 10% of total portfolio only is options. And the reason for that is that the delta on those is much more important to track. So what I mean by that is if you bought something at the money as a put, let's say on EWI, you'd have a 50 delta for something like 2-3 months out. Now, the golden rule is that when that options premium goes down by 50%, at least in my personal trades, which I have tens of thousands of them, I found out that the position never recovers back to being at my cost price. So I just cut them loose. So let's say if I bought a $25 put when EWI was at 25 and it kept going against me and I bought it for say $2, I'm just making up this premium. It's not as high for it, but let's say if it was for $2 and if it went to 1 or below, I just cut it loose. It just means that something was missing in my assessment. I need to just let it go and go back to the drawing board and reassess it and start a fresh trade, maybe at a fresh entry point. So that's for options. As far as the core goes, if I had any short positions, those clearly, as Chris said, I would try to look at them, okay, week over week, month over month, they're going way against me. I do have a risk appetite for specific individual tickers, and that risk rationing is done before I enter the trade. So in whatever limited time you have, like you said, an hour, a weekday, and maybe more hours or the weekend, anytime you enter a trade, always decide what's the risk rationing I'm doing for this and sticking to it. That's how I got out of most of my European shorts. I lost money on European shorts too. Initially, I was making money. Later on, I lost it. And then after that, I just took a pause. I said, okay, let's see what's wrong here and go back to the drawing board for the macro thesis. And many macro prognosticators missed a lot of things in Europe, right? For example, if you look at Bridgewater, they were slammed on their European shorts. They had a large portion of their book short in Europe, and they're totally slammed. So if Bridgewater gets it wrong, I could get it wrong too. That's perfectly fine. And I'm okay with that because I think in investing track record, having a 40-45% win rate is good enough as long as you cut your losers quickly and you ride your winners from a pure trend following perspective. Now, last but not the least, when I say 6 to 10% of total book in options, a single position typically doesn't go beyond 50 to 70 basis points. So I hope that position sizing, portfolio management, as well as the two different sides, stocks and options, help.
Yeah, for sure. I think I saw an initial guidance that it was a 1 to 2% on any given position, but I think I did see one of Robert's update videos going more to 0.5 to 1%, so 50 to 100 basis points.
So 1 to 2% would be more on the direct stock, right? Is that what you're saying? Because 1 to 2% on single options can be deleterious for portfolio returns.
Correct. I think that's what Tony was saying. Yep.
Yeah, correct. I'm now back to 0.5 to 1%, and slow build into that for puts, right? So that's good. I think I did kind of learn my lesson there on that. I've kind of transitioned into that a little bit more, but I wanted to come up and ask that question.
No, it's a really good one. And Tony, just for everybody listening in, if they're interested, I did share that, so I quickly tweeted out. So forgive the very to the point tweet, but it is up on the nest in terms of the link to the beginner's guide, clip playlist. So, that's basically all the ones. I've done 14 episodes since since November, I think it is. So they're all kind of clipped up there and on the YouTube site. So go, if you're looking for a few, you can put me on like 1.5 speed and really pound through them.
I've gotten through a few, but I haven't done all of them. So that's good.
And they're snippets, right? So they're like, as I said, kind of 2 to 12-minute clips. It's not the full episode. I think we'll get those up there as well. But anyway, yeah. So just they're there, so which is greit.
The other part to keep in mind is for options to work for you, I usually take a look at put verticals or call verticals, because see, when you're shorting a country, right? Let's say EWI, Italy is not going to go to zero. So you could define, okay, I'm long 25 put, but I'm going to be short the 20 put, or say 10% down 22 put or something, because you're now playing the vertical, your outlier premium is lesser, right? It's like being at the roulette table, but the minimum is not going to eat away a large portion of your book, so you can play more hands.
The other component too that we've talked about this a number of times on here, and really Chris has pointed this out tons of times as well, is that there's an FX component to many ETFs. Like there's, but in particular the country ETFs, they all have an FX component, right? So with dollar weakness and current in local currency strength, that's going to like adversely impact one way or the other. And Gavin, I remember we had this conversation back when we were bullish on Germany, and you kept getting frustrated on why EWG wasn't working very well for you. And that's really, it's like, okay, like the DAX is up, I'm making up a number, 8%, but EWG is only up like 4. It's like, what the heck, or 3, or whatever the number was. And I remember you being very frustrated with EWG's performance.
Yeah, I was just gonna echo and say, really, forget Europe. Really, what happened there is everyone got caught off. All the dollar bulls, including myself. It's a very challenging time at the end of October into November. That dollar move. If someone was a dollar bull in 2022. And they come across and tell you, I was expecting that move. It's like bullshit. Like a lot of people were not expecting the dollar to sell that hard into the end of the year. And that's just the bottom line. So, and I did some writing about that to think through what happened for me. I made money net on the whole trade, the whole experience from getting back in bigger in August. But then I came back to it. I think I was on the spaces and I was like, okay, I'm starting to buy the dollar again at the end of October. And so the takeaway and what I wanted to say to you, Tony, is like, hey, I'm not on here trying to say like, oh, I get it right all the time. Like that was definitely a challenging spot. And I think, most people were kind of surprised at how much the dollar did kind of sell off into the end of the year. So I have a funny kind of take on it where it's just like I was looking back through my notebook, and during the move that was like the 3 blow off top of like 3 or 4% within a few days, like on September 23rd and like days like that, I was writing like everyone on FinTwit who never talks about the dollar is talking about the dollar. And that's kind of like, once a currency has kind of put in its annual move, which is kind of like 20% is a large move, right? It's like, how much further can it go? And then everyone starts talking about it and knows about the trade. And then it's up 3 or 4% in a few days. Maybe that's it, for right then. Not to say you're going to be bearish on the dollar, but just like, next time, that's the note that I wrote down for myself, like is paying attention to, because if you think about it, like in the beginning of 2022, I remember, a lot of people didn't know to be bullish on the dollar, and Hedgeye did, right? Remember, like through February and March and times like that. And so you watch people over time and like see what the crowd is kind of sensing, the crowd that's really trying to pay attention, right? Not just like, people just YOLOing like Tesla calls or something. But the people who are really trying to pay attention, then all of a sudden everyone is like a chorus. Oh, the US dollar. And then that was for right then, that was like for the trade. And then we'll see now what it's going to do. But anyway, I don't want to, go on and on, but I just wanted to say, Tony, that was a tough time for me too. So that's all.
Yeah, I mean, along like when it's acting or that acted kind of similarly in terms of the grind lower on CTA, right? So Chris called this one out yesterday, the day before to me, in terms of like, have you seen CTA lately? And I mean, that thing has absolutely rebounded off of its lows from earlier this year, from just a couple of weeks ago, or a little over a month ago. And again, you look at the construction, and there's a lot of commodity shorts. There's some FX components in there, some rates, et cetera, et cetera, et cetera. But yeah, I mean, CTA is another one that kind of, Gavin, a lot of those managed futures, it was, they couldn't do anything wrong in terms of the first half of the year. And then all of a sudden, their dollar position started moving against them. And they went from, the darlings of the ball to the ugly stepchild in the corner.
Yeah, and I was interested in that because it had a very high correlation, and I thought it might kind of break off because CTA wasn't around very long, and and now with this dollar 4 or 5 week move back higher a bit, CTA's come back online too. It just has kept that correlation, so it does seem to be trading with the dollar still.
Yeah, Chris, you looked a little bit more closely on the holdings, but it's got a lot of short commodities in it, doesn't it? Right? I don't know.
Yeah. So it's been, So for the last 4 or 5 weeks, it's basically had every perfect trade on that you could have in commodities. It was short. It was short all the right things and long all the right things. So, yeah. I guess the darling of last year was DBMF.
It was DBMF, right?
Which in 2022 could do no wrong, and then most recently, kind of the three big ones that I don't know what I've done on CTA, DBMF, and KMLM. CTA is just kind of wiped the floor with the other two.
Yeah. I think they've I don't know if Gavin, when last time you looked at it, but basically, I mean, they're I think I should pull up the holdings before I believe, they've nailed commodities. They're long some of the ones that have outperformed. I want to say corn, but then they're short natty gas, in size. And so it's
it's
I don't know. No, go on, Gavin.
No, I was just going to say it is handy. Simplify. Not to market anything here, but they do. I remember when I owned it, I did own CTA, and they update their Excel sheet on their website every day. So it's pretty handy. So you could go in and see. I was actually, when we owned the position, I was looking at day over day. Okay, do I agree with kind of what's going on? Because it's not that easy to short commodities, right? So and more of a long only setup. So it's a handy tool. Sorry, go ahead, Chris.
Yeah. DBMF is a replicator, so it does basically does a regression on not all, the top 20 CTAs, and then looks back and says, right, if the CTA benchmark went up 2%, whatever, a year ago, what positions would have fed that 2% rise? So it does a regression on everything and then picks. So obviously for last year, DBMF did really well because it was short all the rates. So it's only got 14 or 15 positions, I think. Because it basically picked the biggest things that CTA's got right over the last, 20, 30, 40 years. And that's been short rates and stuff like that. So 4 or 5, maybe more, 6 positions were short interest rates. So in 2022, that was great. And right now, although rates have moved a lot, it wasn't the big move that we had in 2022. So
it makes sense. That DBMF, it's very interesting. KMLM as well. But anyway, All
I do
right,
want to draw attention to a
yeah,
place
Trent.
where,
Yeah, go ahead.
yeah, where some of the industries are able to push price while going through this inflationary pulse. So the biggest one is heavy construction, and they are a beneficiary of the Inflation Reduction Act as well as China reopening, along with some of the um, specific metals. So, be it steel industry on the whole, be it the um, aluminum industry on the whole, such as ArcelorMittal. So, if you want to play Europe plus these names, there's several tickers in that. In heavy construction space, there's Jacobs Engineering. All of these have extremely good signal. PWR is another ticker. These are having super solid trend in their signals. Definitely have a look at the whole industry. The ones I quoted are mostly large caps. And if you want a first cut at them, go to the components of XLB, B as in Bravo, and XME, the metals one. And you can pick and choose from those which are good signal as per your liking, and then take it from there. So I wanted to add that aspect about what I've observed from my notebook, which wasn't discussed so far.
Yeah, XME I've kind of had in. It's been relatively a very good up. It had been outperforming. It's sort of weak in the last month or so, but yeah, no, definitely. Oh, sorry, I pulled up GDX. Stupid me. I was like, wait, that doesn't look like the XME I looked at this weekend. Yeah, so XME definitely has kind of maintained its strength of signal, in my humble opinion. I don't really know exactly on Keith's risk range what that would look like, but yeah, no, it's a good call out, Trent. Materials, I would kind of differ with you slightly. I got to look more in the construction because I think you were calling out a bit more like the European side of things, right?
Oh, yes, yes. So combination of Europe as well as construction more so in US because the IRA helps US,
Yeah.
but also overall metals, etc. in Europe like ArcelorMittal, right? MT, then LyondellBasell, LYB, LIN, Linde PLC. These are all super strong signals. And I'm talking about not the aggregate ETF. I'm talking about more so specific names within those ETFs.
Yeah, I got you. No, that would make more sense. Yeah, I would agree with you. Yep. I'm on your page there. And it's a good way to kind of hedge too, right? Like if you can run a long short book, we're short XLB, the materials, and mainly because of peak basically late cycle pricing and being able to push that on, which I know Trend you talked about, but with the recession risk rising, our view is from a nowcast model that pricing is no longer really going to be able to push through to the end client. They're going to have to take that on, and the margins are going to shrink. And so their most recent earnings reports are this kind of like the top of the sine curve, I guess, right? So that's our view on the XLB, but I components inside of there. And again, this is a great conversation from kind of a portfolio management, learning the process standpoint. Oftentimes you can, or it can behoove you to sort of have some offsetting positions in terms of, hey, picking out some of the, ones of the best performing signal strengths in there. If you've got the other side of the coin in terms of the general sector itself, right? So if you're long some of the best performing ones, and even if it's on a relative basis, you're going to relatively outperform if you're short the sector itself. I know that's something that you do, Trent. I know that for a fact. Chris, you came on and then we jumped right into Tony's question. So I know you've chatted a decent amount here. Was there anything else on your mind coming in, and especially from a UK perspective, anything you're seeing over in Europe or things that are influencing you on that side of the thing? That side of the Atlantic?
That's the side of the pond.
That's side of the pond. Do you know who won the? Do you know who won the Munich the Bayern Paris Saint-Germain game? I didn't get a chance to see the end score.
No, if it's not Arsenal, I don't really watch
it. I know. Sorry, this is a completely side note, but my sister's down in Barcelona, and she toured the Barcelona stadium. She texted me asking if I wanted to. If I want any like gear, and I was like, I will not be having any gear. I am an avid Arsenal fan, but your nephew would probably love a soccer ball, and your niece and nephew would probably love some small trinket from the Barcelona because they love soccer. They don't necessarily care about who. It was very challenging the other day, Chris, when we were playing Man City because Rory's favorite color is blue. He was very confused.
Red versus blue.
He was very confused. He was like, "But Daddy, I want to root for the blue team." I'm like, "No, we were rooting for the red team, son."
No.
And so anyway, we will get back to the we'll get back to the
12 months ago, we were rooting for the red team.
Yeah, exactly. So we will get back to the notebook. Sorry for the tangent here for those listening in, but yeah.
No, so it's so I've had a short on in the pound for quite a while. That was, which is playing out okay. But in terms of like FX, the big one over the last couple of days has been like the Aussie dollar. A lot of the commodity currencies, the Aussie dollar, the South African rand. Like you ran off a list of some of the European indexes, but like the Aussie index is down. Where are we? Is a second. So so month on month it's down like 4%, which is which obviously the price action has kind of borne that out in commodity space, and it's not all commodities because things like a lot of the ag like live cattle and stuff are still making new highs. So it's not all commodities, but the only other one was Eurodollar futures. So on TradingView, the Eurodollar futures ticker is GE. So if you do 100 minus GE, and it comes up with a little ticker. So the front month is now higher. So it's showing that'll give you the interest rate instead of the bond price. That's like 5.79. So the Eurodollar futures curve is now higher. So the front month Eurodollar futures price is now higher than it was in like coming into the end of the start of 2007.
Wow.
So
So so for those, I just did it. I accidentally selected GE as in General Electric. Now I have it the right one in front of me.
No, that
yes, that one was giving me $13 or something like that, and I was like, wait a second, what is going on here? So can you walk me through that one more time? So it's 100 minus the Eurodollar futures, and then
so if you start,
what is that giving you? Because I've got 5.785. Is that what you got?
That's effectively giving you the rate instead of the bond price.
Got it. Okay.
Like the futures price.
That makes perfect sense. Okay. Yep.
So we're higher now than we were
throughout all of 2022. Yeah.
August 07. So that's we're starting to get into October 2000 kind of territory.
Correct. Yeah. No, that was back in exactly. Yeah, that's really interesting. I'll share this chart later for everybody so that you guys can figure out what we're actually talking about here. But that's a really good trick. I like that in terms of the 100 because I typically just look at the euro dollar itself. I prefer looking at it at this like 5.7. Yeah.
I think Chris could probably work for TradingView like over our time talking together. Like he's always like, oh yeah, this is like on TradingView like this. It's like, how did you even know that?
That's because I can't afford a Bloomie. Is that what the cool kids call it? That's what the cool kids call it, right?
Yeah, they call it a bloomie. Yeah, you afford a TV, a trading
Right.
view. Yeah.
Yeah, that's about it for me.
Cool.
Yeah, so just to continue, Robert, earlier, I was at a noisy spot, so I couldn't speak. But
That's all
from
good.
from those metals and other perspective, right? Some of the international ones, the ones which I called out, they have some interesting dividend kind of outlook too. So while people like to go long short, holding some of these names long also gives that phenomenal yield. For example, LYB, Lyondell Basel, has almost, close to 4 or 5% dividend, and it's not at risk because the free cash flow from operations has been rising. Plus, they have been giving dividends as a fraction of that. Some of it is a buyback from the FCO. So it's not one of the Lumen kind of setup where the whole dividend is gonna be amiss a bit later in the cycle. Also, from a standpoint of most of those names, they tend to not necessarily move in groups or hordes. So that's where you can find some phenomenal long short basis. And this is a specific analysis which I would say if anybody wants to do some sort of a long short will help them for the next uh, 3 to 4 quarters is lay out whichever index you want to benchmark yourself with, right? So be it Russell 2000 or S&P 500, lay out in a descending order of, say, free cash flow yield or overall shareholder yield, which is a combination of dividend plus buyback, and create 4 quartiles. Okay. Once you have done that, you pick your longs from the top quartile, either go short or just ignore the rest of the quartiles. And there's a very high chance that you're going to pick up the winners for the next cycle. Also, if you want to safeguard yourself from unnecessarily high yields, which are sometimes signifying or signaling that the dividend yield may be lost. And that's why I'm not a big fan of dividend yield alone. I'm a fan of shareholder yield. Stick to the second decile. So the top decile tends to be places like Lumen or AT&T where the dividend may go off and your shareholder yield may fall off. So instead of sticking to the top decile, just go to the second decile or second quintile, and you'll find tons of names which are of extremely good value, and they'll probably not fall as much as others. So to give you a very simplistic assessment of this, of what happened in this space, for 2022, just compare S&P 500 versus COWS, COWZ, the Pacer ETF, and you'll find a very significant outperformance by COWS. COWS doesn't quite follow as detailed assessment as I explained, but they definitely pick up the ones which are pretty decent. So that has helped many folks get that dividend income, but at the same time not have as much of a downdraft as S&P 500 did in 2022. So something which would help you in a flat to downward choppy market as well. Also, keep in mind that right now, CDs as well as A-grade bonds, corporate bonds are giving in excess of 5% return. So think about S&P 500 at 18.5 forward yield, which means you're getting an earnings yield of close to 5, with a much wider distribution of outcomes, both on the left and the right side of the distribution. Whereas if you get into some sort of a CD or a money market fund of Vanguard like VMFXX or something like a AA bond or something, then the distribution of outcome is very narrow, right? So what would you prefer? A 5% earning yield with fatter distribution in the tails, or a 5%?
Did I lose
we
him?
lost trend. Yeah, I
Lost.
think we lost
Yeah,
it.
yeah.
Okay. Gotcha. So we'll come back to trend. Blair,
I'll step in.
how you doing, man? Yeah.
Hey.
I've got just for the sake of the room, I've got about 5 minutes, guys, and then I got to wrap up and head down to the train station. So we can
Well, let's keep this
try to
train
finish with
rolling.
Blair, I guess.
Let's keep this train rolling.
All right, buddy.
Coming at you from Laguna
How you doing?
Beach. I'm well. Recovering from
Good.
our first NCAA Best in the West beach volleyball tournament. If you want to see women's college beach volleyball, just go to the AVP channel on YouTube. You can check out some of that for your recreational time. We had a good time, but slowly back in action after the last 4 days getting through that tournament. So that was a lot of fun. We were the title sponsor and dropping some Hedgeye notebook knowledge on guests as they passed through our booth, which was a lot of fun. I think the big call out for me, and I think this is kind of totally opposite from what Trent was just talking about, it is basically being more conservative as we get closer to a quad 4 earnings recession, and not loading up on equities that yield 5 or 6%, but floating rate treasury notes, something that I talked about probably 10 months ago. And I think, you can make it even stronger case for them right now, where you're getting paid almost 5%, which could go to 5.5% if we have 2 more rate hikes by the Fed. Almost zero now.
Blair, I was actually on your side. I was exactly saying the same thing. But my
you
call
were?
came
Okay.
in. Yeah.
Okay. Good. That it just seems like, with the comments from the Outlook, I think it was the macro show this morning, talking about dollars as the biggest allocation. You can hold one of the dollar-based ETFs, but you could also just hold floating rate notes, because that's basically cash that has a floating yield to it that goes up as yields go up. So you get paid to wait, and you get the next rate hike. You don't get any NAV destruction like you would in a normal bond fund. And going back to my comments 2 weeks ago, you are basically playing that cash position the first part of the macro cycle. You're just holding cash, and they're dollars, so it's kind of right in line with the whole macro, cycle positioning, how to allocate your assets in a macro cycle. And then I guess the other thing I would just hit at is gold still holding its bullish trend and at the bottom of the range. As we kind of inch closer to the top of the rate cycle, and I don't think we'll get much beyond 5.5%. That's probably the time to be adding to gold, as long as it maintains its trend. So I guess I'll limit my comments to that, and thank you guys for always chiming in.
No, that's awesome, Blair. Appreciate it. And yeah, the real rates, keep an eye on those. There is a way of looking at it on TradingView. I can share those as well. Unless, Chris, do you know how to do that off the top of your head? It's like DGS, I think 1 minus like 10 year. I forget what it is exactly. I have it. It's in my watch list that I've shared as public. So
yeah, you can just go to like the Treasury has like the latest floating rate note auction rates.
Perfect.
The Treasury's website, and then there are a couple of ETFs out there. If you want to talk about those, call me. I can't, name an ETF on the air, but you're happy to give us a call, look us up.
Sounds good.
And yeah, that's it.
Perfect. Awesome, guys. Well, another great weekly notebook review. Thanks everybody who came up, and Gavin, awesome to have you back, kind of on the scene, buddy. Blair,
yeah,
thanks, man.
As well. Yeah, so thanks everybody. We'll be back here same time next week, 4:30 on Wednesday afternoon, and then Beginner's Guide is tomorrow at 11:30. Sorry, Friday 11:30, and we got Sector Head Spotlight with Ami Joseph, aka Technology. Tomorrow you can catch that live on the YouTube channel as well. So looking forward to seeing everybody again soon. Thanks.